What if I told you that one decision could turn a $100,000 investment into $635,000 or leave it at $485,000? Backed by over a decade of real market data, this comparison reveals how choosing between two popular ETFs, VOO and SCHD, can generate 150% more value over time. But it's not just about picking the one with the biggest number. Today, we're breaking down the actual data and challenging some common assumptions about growth versus dividends. Which ETF truly fits your financial goals? Let's start by looking at what's driving that explosive growth behind one of these funds. Imagine putting $100,000 into an ETF that represents some of the biggest and most successful companies across the US and watching it transform into $635,000. That's the story for investors who've relied on VOO, the Vanguard S&P 500 ETF. But what exactly makes this growth possible? To understand, we need to look at how VOO operates and what drives its performance. VOO is designed to mirror the S&P 500 index, which is a benchmark of 500 of the largest publicly traded companies in the US. By owning VOO, you're essentially buying a slice of the entire US stock market's most influential players. It's considered a passive investment, which means the ETF isn't trying to beat the market. It's simply matching it. This structure makes VOO highly efficient with an expense ratio of just 0.03%. For every $10,000 invested, you're only paying $3 annually to keep your money working. What really sets VOO apart is its tech-heavy allocation. A significant portion of the S&P 500 is made up of technology companies, and that's reflected in VOO's portfolio. As of mid-2025, the information technology sector alone makes up 30.35% of the fund. This has been a huge driver of returns, especially over the past decade, during which technology stocks have performed exceptionally well. Companies like Apple, Microsoft, and Nvidia aren't just familiar household names, they're some of the most valuable businesses on the planet. In VOO, their performance fuels the ETF's overall growth. For instance, Apple currently represents about 6.75% of the fund. Microsoft follows closely at 6.22%, and Nvidia, a company that's benefited massively from the rise of artificial intelligence, makes up about 5.64%. These companies have seen explosive revenue growth, launching them to trillion-dollar valuations. Their success cascades through VOO's returns. Over the past 5 years, VOO has delivered a compound annual growth rate, or CAGR, of 15.9%. That's a number that outpaces many other popular ETFs and is a major reason VOO has become the go-to choice for growth-focused investors. But VOO isn't just about technology. It also holds 14.39% in financials and 10.84% in healthcare, giving investors exposure to other major sectors of the U.S. economy. This diversification helps stabilize the fund to some degree, but there's no escaping the fact that its performance hinges on tech-heavy trends. For growth-seeking investors, that's been good news, but it's important to know what you're really getting. Of course, there's a flip side to this growth. VOO's heavy reliance on large tech names means that when those companies stumble, the fund feels it. For example, during the COVID-19 market crash in early 2020, large-cap technology stocks saw steep declines, dragging VOO's value down with them. However, these same tech giants led the rapid rebound that followed, showing how VOO can swing sharply both ways depending on the fortunes of its biggest holdings. Since its inception in 2010, VOO has maintained a strong long-term track record, even through market cycles, high inflation, and economic uncertainty. This consistency is largely thanks to its focus on large-cap growth stocks. These companies tend to dominate because of their innovation, massive market share, and ability to perform even in challenging economic conditions. Still, investors should recognize that the same concentration that boosts returns can also increase exposure to volatility when tech or large caps underperform. VOO's appeal is clear: low fees, broad exposure to the U.S. market, and a history of impressive growth. For investors who prioritize maximizing returns and can stomach some ups and downs, it's been a powerful wealth-building tool. But it's not necessarily the answer for everyone, especially if your goals lean more towards stability or income. There's another approach that takes a different path, one that puts steady income and resilience front and center. SCHD, the Schwab U.S. Dividend Equity ETF, offers a different philosophy for investors who value income and stability. Instead of chasing the hottest growth sectors, SCHD uses a strict rules-based approach to build its portfolio. Its methodology focuses on selecting financially robust companies with a solid record of paying and growing dividends. The ETF screens for strong cash flow relative to debt, healthy return on equity, sustainable dividend yields, and consistent 5-year dividend growth. This careful selection process helps SCHD avoid yield traps, companies with high dividends that may be masking deeper financial problems. With an expense ratio of just 0.06%, SCHD keeps costs low, and its $68.2 billion in assets under management signals both liquidity and broad investor confidence. The resulting portfolio looks very different from VOO's. SCHD's holdings are concentrated in traditional, defensive sectors: consumer staples, 19.4%, energy, 18.9%, healthcare, 14.5%, and industrials, 13.3%. Its exposure to information technology is much lower, at just 8.9%. This sector mix is intentional, reflecting SCHD's commitment to companies that can deliver reliable dividends through various economic cycles. These industries tend to offer more predictable earnings and are less likely to experience the dramatic swings seen in tech-heavy funds. When you look at SCHD's top holdings, you see names that emphasize stability and steady cash flow. Coca-Cola, at 4.29% of the fund, is a classic example. Its global brand and consistent revenue make it a mainstay for dividend investors. Verizon Communications, also at 4.28%, offers stable income through its telecommunication services, while Cisco Systems, at 4.28%, brings in a tech component but with a strong dividend history. Each of these companies is known for weathering economic ups and downs while continuing to reward shareholders with regular payments. SCHD's performance over time reflects its balanced approach. Over the past 5 years, it has delivered a compound annual growth rate of 12.23%. Looking back 10 years, the CAGR stands at 10.58%. While these numbers are strong, they don't quite match VOO's growth, which is fueled by its heavier allocation to high-flying tech names. SCHD's focus on more stable, income-generating sectors means it generally lags in bull markets, but tends to provide a smoother ride when volatility hits. The real differentiator for SCHD is its dividend yield. At 3.92%, it offers nearly $4,000 in annual income for every $100,000 invested. This steady stream of cash is especially attractive to retirees or anyone prioritizing income over aggressive growth. Instead of relying solely on price appreciation, SCHD investors receive regular, tangible returns that can be reinvested or used as needed. This makes SCHD a practical option for those seeking to balance moderate growth with reliable income, rather than aiming for maximum upside at the cost of higher risk. SCHD's approach also helps cushion the impact of market downturns. Because it leans on sectors tied to essential goods and services, its holdings are less likely to experience sharp declines during economic stress. Defensive sectors like consumer staples and healthcare tend to maintain demand even in tough times, which can help preserve portfolio value and keep dividend payments flowing. However, this same defensive posture means SCHD may miss out on the outsized gains that come from surging tech stocks or speculative growth periods. For investors, the choice comes down to priorities. SCHD is unlikely to deliver the same explosive growth as VOO, but it provides a level of stability and income that appeals to those who want to minimize volatility and generate cash flow. Its rules-based methodology and focus on financial strength make it a reliable tool for building a resilient portfolio, especially when entering a stage of life where regular income matters more than chasing the highest returns. So how do these strategies actually compare when you put your money on the line? The numbers tell a compelling story, and the differences between these two ETFs become especially clear when you see how they perform side by side. Let's put these two ETFs head-to-head in a real-world scenario, VOO versus SCHD, starting October 2011 with a $100,000 investment in each. The results are eye-opening. By mid-2025, your VOO portfolio would have grown to $635,000, while SCHD would have reached $485,000. That's an extra $150,000 in favor of VOO over the same period. But what does this mean for your personal goals? The main reason for this gap is how each ETF is constructed. VOO's edge comes from its heavy allocation to U.S. large-cap growth stocks, especially in the technology sector. Tracking the S&P 500, VOO holds significant stakes in companies like Apple, Microsoft, and Nvidia, firms that have led market gains over the last decade. The tech sector's rise has powered VOO's returns, and you can see this in the numbers. Over the back-tested period, VOO achieved a 14.25% compound annual growth rate, CAGR, versus SCHD's 12.23%. Even when you zoom in on shorter time frames, like the past 5 or 10 years, VOO's growth rate consistently outpaces SCHD's. SCHD, on the other hand, takes a different approach. Its strategy is built around consistent dividend income and financial strength, favoring companies in defensive sectors such as consumer staples, healthcare, and energy. This focus makes SCHD attractive for investors who want stability and regular payouts, but it also means the fund grows at a slower pace. From October 2011 to mid-2025, SCHD delivered a total return of 385% compared to VOO's 535%. The difference is clear. SCHD's approach is more about steady progress and less about chasing the highest possible gains. When it comes to risk, you might expect SCHD's dividend-focused, quality-screened portfolio to offer more protection during turbulent markets. However, the data from the COVID-19 crash in March 2020 tells a different story. In that sharp downturn, both ETFs fell about one-third. VOO by 33.99% and SCHD by 33.37%. Showing SCHD's screens didn't offer major downside protection in that crisis. This suggests that during sudden, severe shocks, the defensive qualities of SCHD don't necessarily shield you any more than VOO's broad market exposure does. That said, SCHD's sector mix can sometimes help cushion smaller pullbacks or provide a smoother ride in more typical market corrections, thanks to its focus on companies that produce essential goods and services. Still, both ETFs are exposed to market risk, and neither one is immune from losses when the entire market takes a hit. VOO's tech-heavy concentration means it can swing more dramatically during downturns, but it also has the potential to recover faster when those same sectors rebound. So, which ETF fits best? If your main goal is to maximize long-term portfolio growth and you can handle some volatility, VOO stands out. Its exposure to high-growth companies has historically generated greater returns, rewarding investors who have the patience and risk tolerance to ride out the bumps. But that growth comes with bigger swings and less focus on providing steady cash flow. If you're more interested in stability and regular income, Perhaps you're nearing retirement or simply prefer a smoother investment ride, SCHD offers a compelling alternative. Its consistent dividends and focus on financially solid companies make it a good fit for those who don't want to rely solely on market appreciation. The trade-off is slower growth, but with the benefit of reliable payouts you can count on. Ultimately, the decision between VOO and SCHD isn't just about chasing the highest number. It's about matching your investment approach to your personal financial goals, risk tolerance, and need for income. But what if you didn't have to choose just one? There's a strategy that lets you capture the strengths of both, potentially creating a portfolio that balances growth and income in a way that's tailored to you. Many investors overlook the idea that you can build a stronger portfolio by blending different ETFs rather than relying on just one. This is known as a multi-ETF strategy, and it's a practical way to combine the strengths of both VOO and SCHD. Instead of forcing yourself to choose between growth and income, you can use both to balance your portfolio, tailoring it to your unique needs and risk tolerance. It's easy to assume that a single ETF gives you enough diversification. VOO holds 500 of the largest U.S. companies, while SCHD focuses on stable, high-quality dividend payers. But each has its own limitations. VOO's tech-driven growth may leave you short on income, while SCHD's steady dividends could mean missing out on explosive market gains. By combining them, you reduce the risk of being overexposed to any one market trend or sector, and you gain access to both long-term appreciation and consistent cash flow. Let's look at a real-world example. If you had split $100,000 between VOO and SCHD using a 70% VOO and 30% SCHD mix, from 2011 to mid-2025, your portfolio would have grown to about $590,000. That's not as high as VOO's solo $635,000, but it's a clear step up from SCHD's $485,000. More importantly, this blend still hits around $590,000, but cushions tech dips with SCHD's dividends. You'd receive a steady income stream, roughly 1.18% of your portfolio annually, adding a layer of reliability that pure growth strategies can't match. If you reinvest those dividends, your returns get an extra boost, narrowing the gap even further. This strategy isn't just about the numbers, it's about managing risk. Market cycles constantly shift, and no sector leads forever. When technology stocks stumble, SCHD's focus on consumer staples, healthcare, and other defensive sectors can help offset the downturn. In stronger markets, VOO's growth engine powers ahead. By holding both, your portfolio becomes more resilient to market swings, and you're less likely to miss out on the upside or get caught in a single sector's decline. Research shows that spreading investments across multiple ETFs can reduce risk while keeping your returns competitive. You don't have to choose between capital appreciation and income. You can enjoy the benefits of both. Plus, your financial priorities will likely change over time. Early in your investing journey, you might want to focus on growth. Later, as you approach retirement or want more financial security, income may take center stage. Adjust the VOO-SCHD ratio over time as your needs evolve. Growth early, income later, rather than sticking to a static allocation. So which split fits your timeline? 80-20 in your 20s or 40-60 as you near retirement? Let us know in the comments. The flexibility of a multi-ETF portfolio means you can make these adjustments as your goals shift, without having to overhaul your entire strategy. Some investors may even find a 50-50 split is just right, striking a balance between growth and income. Others might add ETFs with international or small cap exposure, further diversifying their holdings to match their personal risk profiles. The key is that there's no single right answer. Your investment mix should reflect your own goals, comfort with risk, and time horizon. A multi-ETF approach takes the pressure off trying to predict which strategy will win in any given year. If tech stocks lag, SCHD's dividends keep your portfolio moving forward. If the market surges, VOO ensures you capture those gains. And by reinvesting income, you're compounding your returns no matter what the market is doing. Ultimately, building a portfolio with both VOO and SCHD highlights an important principle. Success isn't about finding a single best ETF, but about creating a strategy that matches your own financial situation. By blending growth and income, you can position yourself for both stability and long-term wealth. This approach puts you in control, letting you adapt as your life and goals change. As you think about your next investment moves, consider how this kind of flexible, diversified strategy might fit your own priorities. Choosing the right ETF isn't about picking a universal winner. It's about matching your investments to your specific goals. Whether you're focused on long-term growth, steady income, or a mix of both, combining VOO and SCHD in a multi-ETF portfolio lets you balance performance and stability as your needs change. If this helped you, hit like and share your ETF split strategy below. Next, we'll explore how international dividend ETFs stack up. Sound interesting? Subscribe to stay updated. Align your investment strategy with your current stage of life, and you'll be better prepared for whatever comes next.